Picture the trading floor from every Wall Street movie you've ever seen. Men in suits, 6 monitors each, screaming numbers, slamming phones down after a big win. That image is burned into our heads. It's dramatic, it's chaotic, and it's mostly fiction. Here's a number that should stop you in your tracks. One of the world's biggest banks pulled in over $50 billion in a single year, and less than half of that came from trading. The rest came from something far quieter: advising companies on billion-dollar mergers, helping businesses raise money, managing fortunes for people who already have more money than they'll ever spend. So if trading isn't the main event anymore, what actually pays the bills at an investment bank? Today we are breaking down the 4 real revenue engines that power the entire industry, why almost nobody else on the planet can compete with these firms, and why people constantly confuse investment banks with hedge funds and regular banks, 3 completely different businesses. By the end of this video, you'll understand Wall Street better than most people who work in finance. Let's get into it. Quick disclaimer before we start. This video is for educational purposes only and is not financial advice. Let's kill the myth first. The idea that banks make their money betting big on the market comes straight from films. The fast cuts, the sweating traders, the champagne after a good quarter. It's entertaining, but it's outdated. After the 2008 financial crisis, regulators around the world cracked down hard on banks making risky bets with their own money. In the United States, this became law through something called the Volcker Rule, which restricts banks from using their own capital for speculative trading. The result? When a modern investment bank trades today, it's almost always executing a transaction on behalf of someone else, a pension fund, a corporation, an insurance company, not gambling with its own cash on where the market goes next. So if it's not gambling, where does the money actually come from? 4 engines. Let's go through every single one. This is the classic image people have of an investment banker, even if they don't know the technical term for it. When one company decides to buy another, it hires a bank to manage the entire process. That means valuing the target company, figuring out what it's actually worth, negotiating the terms of the deal on the client's behalf, structuring the transaction so it doesn't collapse under tax or legal complications, and guiding the client through months of tense back and forth negotiations. Here's the part that surprises most people. The fee isn't a flat rate. It's a percentage of the deal size, and counterintuitively, that percentage shrinks as the deal gets bigger. For a smaller transaction, under $10 million, advisors might charge somewhere between 5 and 10%. But for the mega deals, the billion-dollar-plus transactions, that percentage drops down to roughly 0.5% to 1.5%. That sounds small until you do the math. 1% of $1 billion is $10 million. For a few months of advisory work. And it often doesn't stop there. If the buyer needs to borrow money to fund the purchase, the same bank frequently arranges that financing too, earning a completely separate fee on top. This is also a winner keeps winning business. Once a bank successfully advises a company on one major deal, it usually gets the call again for the next one. That's exactly why the same handful of bank names keep showing up on the biggest deals in the world, year after year. Decades of trust, built one transaction at a time. This engine kicks in when a company wants to raise money, either by selling shares to the public for the first time through an IPO, or by issuing bonds to borrow from investors. Here's the part most people never realize. When a company goes public, the bank doesn't just help sell the shares to investors. In many cases, the bank actually buys the shares from the company first, at an agreed price, and then resells them to the public. Think about what that means. If the resale goes well, the bank profits from the spread between what it paid and what it sold for. But if the resale goes badly, if investor demand is weaker than expected, the bank can get stuck holding shares nobody wants. That's real financial risk sitting on the bank's own balance sheet, not just advice typed up in a slide deck. For taking on that risk and doing the work involved, banks typically earn somewhere between 3 and 7% of the total amount raised in an IPO. Bond issuances are considered safer and more standardized, so the fee is usually lower, generally under 2%. To put this at real-world scale, massive public stock offerings today can raise tens of billions of dollars in a single transaction, split across a syndicate of major banks working together, each earning their slice of that underwriting fee. Modern investment banks mostly aren't betting their own money on whether stocks go up or down. What they're actually doing is called market making. Think of it like a currency exchange booth at an airport. The person behind that counter isn't predicting whether the dollar will rise tomorrow. They're just always ready to buy or sell, profiting from the small gap between the buying price and the selling price, repeated thousands of times a day. Here's a real-world scenario. A pension fund needs to sell $500 million worth of stock without crashing the price in the process. They call a bank. The bank's trading desk handles the transaction, profiting from that tiny spread plus attached fees, not from guessing which direction the market is headed. This is a volume business. Small margin per transaction, but enormous scale. Multiply a tiny profit by millions of trades a day, and you get one of the most consistent revenue streams on Wall Street. This is the least flashy of the four engines, and arguably the smartest, because it's recurring revenue. When a bank manages money for wealthy individuals, pension funds, or institutions, it typically charges an annual management fee, usually somewhere between 0.5% and 1% of total assets under management, every single year, regardless of whether the market goes up or down that year. Why does this matter so much? Compare it to M&A advisory. Those fees are one-time events. The deal closes, the bank gets paid, and then the team has to go find the next deal from scratch. Wealth management fees show up year after year, like a subscription service. The bank doesn't have to win a new client every 12 months to keep collecting. This is why the smartest banks have spent the last 2 decades aggressively building out their wealth and asset management divisions. Because in a volatile world, predictable, recurring fees are worth more than flashy, one-time paydays. Let's make this concrete, because after a while, billions stops meaning anything. Imagine a company gets acquired for $10 billion. The advising bank charges a typical fee for a mega deal, around 0.75%. That works out to $75 million, often earned within 6 to 12 months of work by a team of maybe 20 to 40 bankers. For context, the median annual salary in the United States is roughly $60,000. That single advisory fee is equal to more than 1,000 years of an average person's salary, earned by a relatively small team on one transaction. This is exactly why outsiders assume investment bankers are wildly overpaid for what looks like paperwork. But the real reason this business commands fees at this scale comes down to something much deeper than paperwork. There are 4 reasons this business is nearly impossible to disrupt, even with modern technology. Relationships. CEOs and CFOs don't hire a random bank off a search engine for a $10 billion deal. They call the banker who has known their company for 15 years, who they trust to keep sensitive information confidential during high-stakes negotiations. Distribution. When a company wants to sell billions of dollars in new stock, someone has to actually find buyers willing to write enormous checks, fast. The biggest banks maintain direct relationships with thousands of institutional investors around the world, a network that took decades to build. Balance sheet. Remember underwriting? Sometimes the bank has to buy the shares first, using its own money, before reselling them to the public. That requires tens of billions of dollars in capital sitting ready to absorb risk, capital that a small firm or fintech startup simply doesn't have. Trust. This is the hardest one to quantify, but maybe the most important. When a company is making the biggest financial decision in its history, it wants an advisor with a proven track record of discretion and competence, not the lowest bidder. That trust is built deal by deal over years, and a single leak or a botched IPO can destroy it overnight. Put all 4 together, relationships, distribution, balance sheet, and trust, and you get a business that's almost impossible to disrupt with a clever app or a lower fee. That's the real moat protecting Wall Street's biggest players. Here's a mix-up that happens constantly, and untangling it will change how you think about the entire financial industry. People throw around the terms investment bank, hedge fund, and commercial bank like they're interchangeable. They are not even close to the same thing. A commercial bank is the one near your house. It takes deposits, pays a little interest, and lends that money out as mortgages and car loans. That's its retail role. A hedge fund is a private investment firm that takes money from wealthy investors and institutions and actively bets on markets to generate returns. This is closer to the risky, gambling image people associate with Wall Street, though even that's an oversimplification. An investment bank does neither of these as its core business. It's a facilitator for deals, for fundraising, for trading flow, and for managing institutional and high net worth clients' money. Some large financial firms blend a commercial bank and an investment bank under one roof, which only adds to public confusion. But these are fundamentally different businesses, with completely different risk profiles. This distinction matters because when people criticize banks for reckless gambling, they're often actually describing hedge fund behavior or pre-2008 trading practices that, in that form, largely don't exist anymore. So next time someone pictures an investment bank as a room full of guys yelling buy, buy, buy at a screen, you'll know the real story. 4 engines: advisory, underwriting, trading, and wealth management. 4 reasons nobody can compete: relationships, distribution, balance sheet, and trust. If this video helped you understand how Wall Street really works, do me a huge favor and hit that like button. It genuinely helps this channel grow. And if you want more videos that break down finance and investing in plain English, hit subscribe and turn on notifications so you don't miss the next one. Drop a comment and let me know, which of these 4 engines surprised you the most? I read every comment and I'll see you in the next video. Thanks for watching.